Can I tell you a little secret? Accrual basis and cash basis is way more important than you're giving it credit for in your software dev agency. I'm Tony, and in this video, I'm going to explain the pros and cons of both, but ultimately show you why accrual basis takes the cake for dev agencies with an appetite for growth. So first of all, what is accrual basis accounting? Very simply put, accrual basis is essentially saying when you have earned revenue or when you have been obligated to pay a cost. So a simplest example of accrual basis would be I have worked on a website that I completed on December 15th, but as part of my contract with my client, I expect to be paid 30 days later. So if I bill them on the 15th, I've completed the work on December 15th, 2022, but I don't get paid until January 15th, 2023. Where have I recognized the revenue? Now, under accrual basis, because I have earned the revenue in 2022, because I completed the work, I would recognize that revenue in 2022. December 15th, 2022. Now, under cash basis, I would recognize that revenue on January 15th, 2023. So you can see the disconnect there. Accrual is when I've earned it. Cash is when I've actually gotten paid. And then on the flip side, when we're talking about expenses, it's when I'm obligated to pay something versus for cash basis, it's when I've actually paid something. The same scenario could be said. Maybe I'm the company that has received the website development. And if I've received a bill because they've completed the development of the website, I would show an expense in 2022 for that work that was done. Under cash basis, I would not recognize that expense until I paid it in 2023. That's a very simple example of the difference between accrual basis and cash basis. So let's talk about some of the pros for why accrual basis makes so much more sense for a software dev agency. First and foremost, I feel so much more trust in the numbers when I see accrual basis numbers. Why do I say that? I'll give you a simple example. Let's say, like many custom software projects, I have a $100,000 project that's going to take place over the period of the next 12 months. But as part of that contract, I get a massive upfront deposit. Call it $25,000. On day one, I have invoiced $25,000, but I haven't really earned any of that $25,000. Under accrual basis, I would do what's called a revenue deferral for that $25,000, and I would only recognize the revenue that I actually earned ratably through the project period. Under cash basis, I just say, shoot, I received the cash, $25,000 up front. That is like a sugar rush of revenue. So when I'm comparing the numbers I'm looking at, accrual basis versus cash basis, under accrual basis, I'm gonna see a pretty even-keeled revenue figure that actually matches my production. Under cash basis, on the other hand, it's gonna be all over the place. On the flip side, I might have done the work, but just haven't actually received the cash yet. Why would it make any sense for me to show I have $0 in revenue when clearly I've put a bunch of costs into the project? So right there, I feel so much more confident when I look at accrual basis numbers that I'm looking at something that's meaningful, that I can draw conclusions from. And one of the most important metrics that we track in software dev agencies are gross margins. If you remember, gross margins are revenues minus direct costs, which gets you gross profit, and then you take gross profit divided by revenue. That's what you get a gross margin. If I am on a cash basis, my revenue is going to be all over the place. And sometimes my costs are also going to be all over the place. But if I am on accrual basis, I'm going to have a relatively consistent production of revenue and consistent costs that are generated in producing that revenue. So I feel really confident that I can trust the gross margin figures. I can also trust figures like my effective hourly rate because I know that the revenue figure that I'm looking at is actually legitimate. Another pro for accrual basis is that it is inherently easier to budget. Now that might seem counterintuitive, but usually when you think about setting a budget for your business, you're not often thinking about when exactly you're going to be paying a bill. That's not always the case. Sometimes you know that there's certain tax bills or there's certain licenses or insurance costs that you do think about in cash basis. But typically when you think about projecting out revenues or estimating your costs, you're typically thinking in accrual basis, not cash basis. So accrual basis tends to be an easier way of budgeting for your business. Now, accrual basis isn't without its cons. There are some drawbacks that make it a little bit more challenging. Number one, accrual basis is typically more expensive and more time consuming. Quite frankly, I, in the accounting and finance space, have a little bit more work to do, and therefore I charge a little bit more money because we work with accrual basis figures. So we're doing things like talking about what was your percentage completion at the end of every period. We're properly deferring a prepaid expense and amortizing it over the period. We're doing all of these things to identify where we need to be correct from an accrual perspective, and that just takes time and can sometimes be a little bit more complicated than the average DIY bookkeeper would normally do. And as a result, you're typically going to need to work with an accountant. Now, sometimes you will get really lucky and you'll get a bookkeeper who actually understands accrual basis accounting, but for the most part, you do need to work with an accountant because they're going to be the ones who better understand how to implement accrual basis in your dev agency. The last con that I would say for accrual basis is sometimes there's a little bit of a disconnect between what you see in the bank and what you see in your profit and loss statement. And this actually happened with one of my clients. He straight up asked me, he said, how is it that my bank account looks so good when my P&L looks so bad? And this is a very common issue and difference between cash basis and accrual basis. Not saying that that's a bad thing, just saying that sometimes it can cause confusion to a less sophisticated financial person. All right, we talked about accrual basis. Let's talk a little bit about cash basis. Previously, when I talked about accrual basis, I gave a couple examples of the difference between accrual and cash. So just again to recap, cash basis is when I've actually physically been paid or when I myself have paid for something. That's when you recognize the revenues or the expenses. So some of the pros for cash basis on the flip side are it tends to be a much easier way of doing your books, right? I like to say cash basis is basically categorizing cash transactions from your bank account. That's it. There's a couple additional things you would include in there, but for the most part, that's cash basis. So it doesn't require much financial sophistication in order to pull off. So as a result, a non-accounting person can do it, which means typically if you are doing your own books in-house, you're typically doing it on cash basis. Also, if you're working with just a bookkeeper and not an accountant, you can get away with that on cash basis. Another pro is it's really the only requirement you need in order to file your taxes at the end of the year. The one caveat there being if you're working in an inventory business or a couple other scenarios where you are required to report on accrual basis, but for most software dev agencies, that is not going to be applicable. All right, now to some of the cons for cash. Just like I talked about for accrual basis, I feel really confident that I can trust the numbers. With cash basis, I have a really hard time making any meaningful management decisions. So again, in an example, let's say we have a $100,000 project where we get a 25% upfront deposit. That's $25,000 in the bank that we just received, which means under cash basis, that's $25,000 of revenue. Let's say I only logged 2 hours worth of work in that month that I got the $25,000. What would my effective hourly rate be? Ridiculously high. So every time I read that financial dashboard, I'm going to think to myself, okay, but I didn't actually make $25,000 on 2 hours worth of work. I really had to do, and before you know it, you've got all this mental math that you have to do, and you just can't trust the numbers to make good management decisions. That's one issue I have with cash basis. It's really hard to trust the numbers to make good management decisions. Another big issue with cash basis is it's actually really hard to determine if you have a client payment problem. Now again, this seems counterintuitive, but bear with me for a minute. The days sales outstanding, or DSO metric that we track, relies on an outstanding accounts receivable balance, otherwise known as AR. Under cash basis, technically, you never have accounts receivable. So you can never really calculate your days sales outstanding. Instead, what you get is just this mire mess of, I don't know when the average time is my clients are actually paying. The only thing you really know is on my invoices, I've given them net 15 or net 30 or net 60, but you don't objectively know how quickly they're actually paying on the whole. Under cash basis, you're limited in that way. Back to what we were talking about before, I said I can't really trust the numbers, and consequently, I can't trust the metrics, right? So we talked about an example of the effective hourly rate. If I made $25,000 in cash on the deposit, but I only worked 2 hours, I'm not going to trust my effective hourly rate right there because it is clearly not accurate. Likewise, I can almost never trust my gross margins to be correct because sometimes I missed an accrual, sometimes I missed a deferral, and before you know it, you have this super lumpy month over month comparison where one month you might have 90% gross margins and then the next month you have 10% gross margins. You don't know objectively whether that is a client issue or just a timing issue. You want to eliminate the timing so that all you're left with is truly the data you need to make good management decisions. And finally, as a con for cash basis method of accounting, it's actually really hard to cash flow forecast. Again, that seems counterintuitive, but bear with me. Because we don't have data like days sales outstanding, we don't have any clear indication of what your cash conversion cycle is unless you're on accrual basis. And if you don't know what your cash conversion cycle is, you can't, with relative accuracy, project out your cash flows. Now, by all means, you can do a good job trying to predict for the next 30 days on a daily basis what you think things are going to be. But if you want a machine that's going to be able to consistently project out your future cash flows, you're going to need to base your model off of certain assumptions. So again, under cash basis, you don't have great data, so you also can't really cash flow forecast super well. All right, so we talked a little bit about accrual basis and cash basis. What's officially my recommendation for you? If you are making more than $500,000 in revenue as a dev agency, no questions asked, move to accrual basis. There is no better way for you to be able to make good management decisions than when you have accrual basis numbers in front of you at all times. You're gonna do such a better job projecting out your cash flows, and you're gonna make better decisions on what kind of clients you need to fire, what kind of clients you need to pursue, and also if you need to modify your niche or the types of projects that you're taking on. You're gonna really struggle to do that under cash basis method of accounting. So all in all, my official stamp of approval is go for accrual basis if your business is big enough. If you're still under $500,000 in revenue, I could see a case made that the main purpose for your books is to be able to file your taxes, and that's fine. But once you get above $500,000 in revenue, you're really starting to enter into growth mode, and you're gonna need that data in order to make better management decisions to grow profitably. So accrual basis is my official recommendation. Now you might even have both of these systems figured out, but still you cycle between feast and famine every month and worry about each project and how profitable it's gonna be. Now, if that's you, you could be missing out on one key thing that prevents you from estimating project time and cost. Now, I'm going to tell you about what it is and how never to be unprofitable again in this video here. Be sure to watch it, and I'll see you in the next video.